Hi, this is Wes Middleton. Welcome back for another tax tip. Today we're going to talk about one more area in the tax code that's changed, and this is the new interest expense limitation. And what we're going to talk about specifically today is another exception to the $25 million rule that may be catching people unaware if they're not really careful. So here's the basis of the rule. Your interest in your business is now limited to 30% of your adjusted taxable income. And I'm not going to go into that calculation for the purpose of this session. What I want to talk about is the exception to your interest deduction being limited. So first of all, if you're in the real estate industry specifically, this really could affect you because this is a common setup issue that we see in many real estate partnerships. So while this limitation, there's an exception for you if your gross receipts average $25 million. So it's the small business taxpayer exception that comes into play with this $25 million limitation. So the general rule is if your gross receipts are less than $25 million, hey, you don't have to worry about this limitation to your interest expense deduction. Well, here's the area that some people are missing and you've got to pay real close attention to is while there's an exception to the rule, there's an exception to the exception, and that is this. This $25 million exception does not apply to you if you're considered a tax shelter. So I know your first response is, hey, I'm not a tax shelter. Well, that's where you have to be really, really careful is because the definition of a tax shelter under this specific rule is different than any other definition of a tax shelter. And so while you may not be a tax shelter for every other part of the law, in this specific instance, you could very well be a tax shelter. So who is a tax shelter? The bottom line is this. If you have a partnership and 30% or more of the losses are allocated to other entities, you are a tax shelter. So think about it. Every limited partnership in Texas, for example, that I'm aware of, has a general partner that's an entity. And for the most part, entities make up the remainder of the investors in a partnership. So in this case, unless those just happen to all be individuals, you are going to have to check and see if you are a tax shelter, because if 30% or more of the ownership or the allocation of the losses is the way to put it, goes to other entities, you are going to be a tax shelter for the discussion of this tax law. So don't be caught unaware by this little gotcha that's sitting in the interest deduction limitation. So just to recap real quick, your interest expense deduction is limited to 30% of your taxable income as adjusted and defined in the new tax law, unless you have average gross receipts of $25 million or less. And the exception to that is unless you're a tax shelter. So if you want to know more about that, if you're not sure if you're a tax shelter, go to www.mrzllp.com, click on our Idea Center, scroll down to the blog, and much more information is there. And if you need more information, you can click on the link there. Reach out to our team here at MRZ, and we're happy to follow up with more information and answer your questions. Thanks for joining me. I'll see you again next time.